The end of the year is approaching, and today we have the top 10 tax moves you should do before the end of 2025. Welcome back to the Zacc Call Money Education Channel. I'm here to help you get better at money. So subscribe here today so that you can get this video as well as the tax video we'll do at the beginning of the year that will outline all of the new tax rules that come with every single year's change. Also, you'll get the full list of these 10 moves plus a couple bonus items at the very end. And in the description, we'll give you a downloadable worksheet you could use to check off to make sure you've taken care of every single one. My name is Zacc Call. I'm the president at Capita Financial Network. Let's dive in. Number 1, avoid underpayment penalties. This is something that mostly needs to be done before December 31st. Self-employed people can make a payment at the beginning of the next year to account for this year's taxes. But the most important thing for you to understand is that there are rules that you must pay enough of your tax bill throughout the tax year to avoid having to pay any penalties. The rules work out to be 90% of this year's tax liability or 100% of the previous tax year's liability. If your income is over $150,000, they make you use 110% of last year's tax liability. So you figure out the lesser of those two numbers, 90% of this year's or 100 or 110% of last year's. And whichever number is lower, as long as you have paid that amount in taxes toward 2025's tax bill, you'll be fine. You won't have any penalties. However, if you don't pay that much, you can be penalized on the difference when it comes time to file your taxes. Number 2, capital gain harvesting. This is weird, but you're going to actually purposefully take capital gains, meaning selling an investment at a gain because it is advantageous to you. There are some circumstances in which you can get 0% tax rate applied to your capital gains. Now, we're talking about typically long-term capital gains, those that are on investments held more than a year at low tax brackets. In addition to that, you can actually harvest some capital gains if you have accounts for your kids. And because of their deduction and their extra little exemption in that space, they can get rid of the capital gain tax on that as well. There's more detail exactly as to where those lines are. Typically, if you're in the 10 and 12% tax brackets, for your regular rates, you're typically also in the 0% tax bracket for long-term capital gains. Talk to us if you want to get more detail on that. But capital gain harvesting can get you money out completely tax-free. Number 3, tax loss harvesting. This is the opposite of gain harvesting. The idea here is you have normal fluctuation in your investments. We all hope that all of our investments go up in value, but there will be normal fluctuation. And as they are temporarily down, you can lock in that loss, buy something else that will come up in a similar rate. And then after 30 days, you can switch back to the original investment. That will avoid something called a wash sale. The point of tax loss harvesting is you get to use that loss against future gains. And the nice part is it can carry over year. So if you have losses of $1 million in your portfolio, it may sound crazy, but it's okay in the sense that you can lock in those and continue to use them year over year against gains. It takes some of the portfolio management handcuffs off, meaning it makes it so that your decisions around risk and return and the quality of an investment can take even higher priority because you don't have to worry about the tax ramifications from selling because all those losses are offsetting the gains. Now, another extra little benefit is that you can use up to $3,000 per year against your income tax. Income tax is typically higher than long-term capital gains. So any chance I can get to avoid maybe a 22% tax and later, someday in the future, pay 15% capital gains, I'm going to make that trade-off. And in many cases, the gap is even wider. Number 4, adjust retirement account contributions. Right now, I'm talking about the contributions that happen through your paycheck through work. So your maximum contribution limits to accounts like 401k, 403b, those are $23,000 $500. You can do a catch-up contribution if you're over 50 of an additional $7,500. And there's a fairly recent new rule. They're calling it a super catch-up for people that are age 60 up until 63. It's this tight window as you're giving the final push towards retirement that instead of a $7,500 catch-up contribution, you can do $11,250. So the $23,500 is standard for everyone. For anybody over 50, they can do $7,500 more. But if you're in that tight window, instead of $7,500, it's $11,250. Now, your paycheck usually requires that you set aside a percentage to go towards these accounts. So sometimes it can be difficult to predict your exact income and what percentage will help you hit these maximum contribution limits. So typically before year end, before you run out of payroll periods, it's important to take a look at how much you've contributed for the year and adjust that percentage if you're really trying to hit the maximum available to you based on your age. And you may need to adjust up or adjust down, especially if you're going to max out too early. Some employers will make it so that if you max out too early, you miss out on some matching contributions. You get free money typically when you put money in a 401k plan. And if you max it out too early and you can't contribute, your employer can't match on any contributions that you're not making. So really be careful not to max out too early if you have a plan that in which the match works like that, or if you're just trying to make sure you max out or hit enough, go ahead and increase to the right amount. So that is for retirement plans at work. In addition to that, you may be a self-employed individual with a SEP IRA or a simple IRA. We won't get into detail with that, but those also have requirements to make contributions, oftentimes before the end of the year. So now thinking about number 5 is maxing or adjusting your contributions to outside personal retirement accounts. I call it outside because it's outside of your work. So your own individual retirement accounts. Technically, you have all the way until you file or April 15th of next year, but it is worth taking a little bit of a look right now to ensure that you're on target to reach your contribution limits that you'd like to hit before year end. Number 6, Roth Conversions. That's different than a contribution. Contributions, you can wait until you file your taxes or the April 15th deadline. A Roth conversion is when you take money from a traditional account, pay taxes on it purposefully, and convert it into tax-free growth money inside a Roth IRA. This must be done before December 31st. And in addition to that, the firm will need some processing time. Whatever brokerage firm or account provider you have, they're going to want some processing time, and they get very busy at the end of the year. I would try to wrap up your Roth conversions in November, early December, if possible. Now, why would you do this? You would do it because you're currently sitting at a low tax bracket and you'd like to take advantage of that really low tax rate. Maybe in retirement, your rate will go up a little bit or maybe up a lot, and you don't want to have to pay that future higher tax rate. You can do that, do a conversion, and take advantage of that lower rate today and lock that in, and all the growth will be tax-free. There are many other reasons to do it, including controlling your taxes in retirement better. We're finding that this is a very comprehensive analysis over an entire lifetime to get the Roth conversion game right. So reach out to us if you'd like to talk about that. Number 7, use up your Flex Savings Account, or FSA, or any use it or lose it benefits. Use it or lose it benefits are those that you must use within the calendar year, or they completely go away. An FSA is a health-related account that you can use for healthcare expenses, but if you don't use it, you lose it. That's different than an HSA. An HSA is an account that carries over, the balance can be invested, and you can grow it for your entire lifetime. But an FSA disappears after the end of the year. Make sure you don't leave any of that money on the table. Also, if you didn't use as much as you thought, you should consider adjusting your contributions down into the FSA from your paycheck. Maybe you don't need that much for 2026. Number 8, review and sign up for employee benefits and employer plans. There are many cases in which employees don't know that they have free or low-cost options available to them because they don't go through their benefit package. And often this is an October, November time period where you make all your elections for the next year. So before that time period ends, and it's different by your employer, before that time period ends, ensure that you have reviewed your benefits and you're taking advantage of what's available to you. Things that sometimes people forget are employee stock purchase plans. There are legal plans if you would like to get your estate planning done for pretty low cost. There are flex savings accounts, HSAs, gym memberships. There's so much that could be available to you in addition to the retirement savings accounts that are typically available. Ensure that you have reviewed all of that, and in particular, the most important is your health insurance elections. Review your options, think about which type of plan is best for you if you're offered more than one, and then make sure you sign up for it so that you have healthcare coverage for the entire year of 2026 as well. Number 9, required minimum distributions and qualified charitable distributions. That's a mouthful. Normally people just say RMDs and QCDs. So what is an RMD? You have had a tax-free account if you have a traditional IRA or a traditional 401k. And the government is saying, at some point, we want you to take money out of that account and pay taxes on it. So as you take money out, you have to report that on your income. It adds to your income and you pay taxes on it. And this required distribution starts at different ages, depending on your year of birth. Could be 70 and a half up to 75. So every year you'll have to take money out and pay taxes on it. Now, you can manage the strategy well if in advance you start to think about things that we've already talked about, like Roth conversions or other withdrawals. But most importantly, if you are RMD age, ensure that you have taken the entire required minimum distribution. Oftentimes, you can ask for an exception if you have made a mistake. But the mistake penalty, if you don't get approved, is a 50% on the amount that you were supposed to take out. It's hefty, it's difficult. Make sure you take the required minimum distribution. One way to manage your required distribution, if you are charitably inclined, is to use a qualified charitable distribution, the QCD. The QCD is a strategy where you take money from your IRA and instead of putting it in your own bank account, you have it go directly to a charity. When I say directly, the institution could mail you a check, but as long as it's written out to the charity and you send it to the charity, that still counts. So that's a qualified charitable distribution. A qualified charitable distribution will make it so that it never shows up on your own tax return, eliminating the need to pay taxes on that income as you take it out. Many of our clients and many of our retirees use QCDs to manage and reduce the tax associated with their RMDs. Speaking of charitable giving, that leads us to number 10. So before the end of the year, you should finalize your charitable giving. It's important that you understand the difference between standard deductions and itemized deductions. There is a standard amount that anyone can reduce their income by based on a standard rule the government has set. For single people, it's about $15,000. For married people, it's $30,000. Married filing separately is $15,000, and head of household is $22,500. So these are numbers that you should know so that as you have other, let's call them approved deductions, the government calls them itemized deductions, you can add those up and see if they will exceed your standard deduction. It's important to understand this as you think about your charitable giving. If your charitable giving will exceed the standard deduction, you'll want to be aware of that before December 31st, and maybe you choose to give a little bit more or give a little bit less based on tax reasons. Obviously, the goal is to do good in the world and your charity is the top priority. But if you can benefit from the tax savings a little bit more, it's important to strategize around your charitable giving at the end of the year. So this is number 10, finalize charitable giving. Okay, if you've made it through our top 10 tax moves before the end of 2025, I'm going to give you 3 bonus items. They're not necessarily as urgent as the first 10, but they are super important. So, number 11, filing status changes. Did you get married? Did you get divorced? Are you filing separately as a married couple or head of household? If you change your filing status, that is typically the most dramatic impact to your tax return. And it's something you should be thinking about before year end. if you are in that situation. Number 12, review any taxable transactions that happen throughout the year. This could be things like a home sale, an investment sale, year-to-date dividends and interest and capital gains. It's hard because you don't have the tax reports yet. Those usually come in February, but at least you can estimate and get a feel for what it will look like. Other items would be a job change, a raise, and so much more. So think about those tax transactions, things that are going to change your income throughout the year. Before the end of the year, you might choose to use one of these strategies to manage that. And number 13, this is something that we do for our clients if they would like, and it's a mock-up of your 2025 tax return. We can take your situation from last year, mock it up into a hypothetical tax return for 2025, adjust the numbers based on whatever you tell us. If you got a raise again, or if you gave more to charity, or you had less or more mortgage interest. And we can mock that up and get a really good feel for what your tax bill will look like. This could help with things like making sure that you've paid enough throughout the year. Accountants are pretty good at helping with that as well, but we tend to get a little bit more into the strategy than an accountant would with hypotheticals of, well, what if we converted this amount? What if we changed this? And so reach out to us, client or not, we're happy to talk to you about how that works, as well as give you some ideas on how to improve your tax situation. Okay, so this is our top 10 list of tax moves you should make before the end of 2025. I'm going to do a quick recap of all 10 if you've made it this far, and then make sure you like and subscribe, follow us, because we'll do this again at the beginning of the year with a very robust outline of all of the new tax lines. A lot of the various marginal brackets and standard deductions, they all change just a little bit. Contribution maximums, they change just a little bit. So item number 1 was avoid underpayment penalties. Item number 2, capital gain harvesting. Item number 3, tax loss harvesting. Number 4, adjust your retirement account contributions at work. Number 5, adjust your personal retirement account contributions. Number 6, Roth Conversions. Number 7, use FSA or use it or lose it benefits. Number 8, review and sign up for employee benefits or employer plans. And number 9, required minimum distributions and qualified charitable distributions. Number 10, finalize charitable giving. Great job making it through the top 10 tax moves to make before the end of 2025. If you are paying attention to these 10 and then these 3 bonus items, you're doing better than most everyone with regard to managing your own tax situation well. We would love to help you in this process. It's something we do for our clients. We would be glad to mock up a tax return, to give you ideas and strategize with you on how to ensure that you make the most of every dollar by keeping the most you can of every dollar. Now, our mission is to ensure that you have a better life through better money decisions. This channel obviously is educational in nature. If you'd like to talk to us individually and review your exact situation, reach out to us. And remember, you can find the checklist for all these items in the description below. And you can find plenty of educational material on our channel. So make sure that you subscribe and stick around for all the new content coming to you. Again, thank you for being here on the Zacc Call Money Education channel.